Well, good afternoon, investors. Welcome to our July 23rd edition of Bull Sessions. My name is Mark Robertson. My colleague, the magical, magnificent mathematician from mid-Michigan, Ken Kavula, is actually taking a break and running around on the southern shores of Canada, someplace up north of here. And that sounds like a pretty good idea, and wish him the best. He will be back soon. I am joined here by two very special guests. I'm not sure where you're at, Kim, but Kim Butcher, are you back in Florida or?
No, I'm in Indiana fixing. I'm playing maintenance on a house I hadn't been into for like 5 years. So,
Ouch.
ouch is right. Let's see. Last week I had to get a new air conditioning furnace for the whole house, and I had to get air conditioning in my car and plumbing work done.
Well, it's probably been fairly warm there in southern Indiana also, just to make it tougher.
It's amazing how much one can sleep better when one has air conditioning.
I agree with that completely. And we're also joined by our dear friend from the East Coast, Kevin Gologly. Good afternoon, Kevin.
See, you call my name and I'm like Beetlejuice. I'm here.
Yep, you're here just to keep us all on our toes, and we greatly appreciate that. Matt Spielman is also traveling, and he is returning to Houston probably as we speak, so he won't be joining us today unless he stumbles in at some point a little bit later on. We're going to talk about the small companies that we love to kick around. That is an angry rabbit on the upper left, and just thought it'd be kind of nice to give him his moment in the sun versus the AI and robotic revolution that's out there. We also will take a look at the beginning of an effort to update our favorite books on investing. It's been a while since we've done that, and kind of fun to go back and look at that. And then, as we promised, we're going to take a look at how that collection of electric infrastructure companies is doing 1 year later, and we'll probably be thinking about potential changes, that sort of thing, over the next few sessions or whatever. Anything else you guys would like to add, or questions, comments?
Not as far as I know.
Okay, we're good
Let's
to
keep
go.
moving.
Let's keep moving with our weekly hot dog helping. And a friend of mine pointed out that the Livonia, Michigan store is now open. And on the heels of National Hot Dog Week, good times. This is also your weekly reminder that Portillo's is not a sponsor of this session, but they should be. And we are still in need of some stock price support, so everybody get out there and buy a hot dog. For myself as a shareholder, Kim, I think you're also a shareholder. Is that correct?
Not until the price would be a little better in the upcline rather than the downcline.
Oh no, you're doing the right thing. I think I invested with my stomach instead of my
Your brain.
brain, I guess. Anyhow,
Mark, I was thinking of you yesterday when my YouTube feed had a story on a place called Superdog on the northwest side of Chicago.
I saw that.
It's sort of like Portillo's, but not as franchised.
Give them time. Maybe they will make the stretch for the golden ticket themselves. All right.
After driving up from Florida to Indiana, and I had to stop at 2 Buc-ee's, I'm like, oh, maybe Buc-ee's needs to be a stop too.
Well, we are watching Buc-ee's carefully, as well as Torchy's, and Chewy's just went. They were just acquired by another company. Anyhow, here's our standard disclaimer: no investment.
I'd go with Culver's if it ever goes public.
I think it is public. I'll have to look. I think it might.
I thought I'll look it up while you talk. Go on.
Okay. No investment recommendation is intended by what we do here. It's an educational demonstration fully intended to illustrate and demonstrate the philosophies, methods, and techniques of the modern investment club movement. Plainly speaking, we like to figure out how to discover investment opportunities that are compelling, and we actually walk through the analysis of how we decide how compelling they are. And the community that we're centered on has actually been doing this now for nearly 8 decades. So we have a lot of successful investing lessons that we can lean on and learn. And so we simply like to share ideas and explore and try to improve our overall investing experience, making it as successful as we can. There are no guarantees. We know that, but we do think that putting our heads together is a pretty good idea. If we own something, we'll try to disclose that. Again, if you, we know that you're smart enough to make your own decisions about the investments you make and the tools that you use. Our two email addresses are there at the bottom if you would like copies of the slides or if you have follow-up questions, or even more importantly, suggestions for future topics that you'd like to see us cover. Send an email to either one of us and we'll be okay with that. We'd appreciate it. Thank you.
Culver's is privately held.
Still privately held. Okay, we'll add that to the watch list and hope for the best. Here's our quick look at the market. We basically do this every week where we take a look at the value line arithmetic average as a measure of the stock market. That's the green bars. Those are quarterly bars. The bar on the right is a work in progress, being the current quarter, which comes to an end at the end of September. And the two ziggy and zaggy lines, the red one is the median projected annual return. That's basically as if you had done a stock selection guide-based study on all of the companies that we cover, about 2,600 companies, and come up with an average. That averages, again, in that 9 to 10% range. The gold one, which kind of tracks it, they pretty much track each other. We are cousins or brothers or something separated at birth. They look at the world of investing very much like we do, and you can see that their forecast is also in that approximately 10% range. Right now, again, that's the long-term forecast for the companies that they cover. That blue line is actually inspired by Jim Clunan, the former chairman of the American Association of Investors. He wrote a great book a couple years ago that this is actually co-opted from, but that line of reasonable expectations kind of gives us a feel for where we're at in the market. Anytime that green bar is slightly below the blue line, there's probably a little bit more opportunity out there and stocks are possibly slightly undervalued. That's probably not what you're hearing on the nightly news. Anything you'd like to add, Kim or Kevin?
No,
Nope.
I just think it's going to be interesting to see how the stock market reacts or not to anything of our political environment at the moment.
Yeah, I mean, we've talked about that the last few weeks. Our experience has always been over the years that you just kind of put your head down and buy great companies at good prices, and it kind of takes care of itself in the long run. And don't want to overthink it. What are your thoughts on that, Kevin? You live in the middle of the, we can call you Beltway Kevin.
Yeah, well, I'm outside the Beltway. I'm inside the Baltimore Beltway. But no, to me, I see there, it reminds me of the old line from my statistics class in college, which is if you see ice cream consumption peaks just before crime does. So the premise being that ice cream consumption causes crime, and it's a spurious relationship. And to me, this whole thing of like, you know, if the Democrats are in Congress, control Congress, and the Republicans control the White House and all the other different things that go in there, I find most of that kind of hooey. It's right up there with like whoever wins the World Series, the American League or the National League. It depends on how it is. I mean, it's irrelevant to what we're trying to do as long-term fundamental investors. If we were momentum players, maybe I could see some correlation, but I see little in our realm.
Yeah, and that's
all
why
the politics I will add today.
Yeah, you hear about it and you read about it. That's what they're trying to do. They're trying to trade a situation, and that's not easy. Some do it pretty well.
Yeah.
Again, here's kind of what Kevin was just talking about. This is a return to our long-term performance perspectives, where we've basically laid out the top 10 most widely, I guess, widely followed companies by our community. Those at the top, and then we recently added Home Depot, Stryker, and CVS Health as numbers 8, 9, and 10, just to give everybody an idea of how these companies fall in. So you're looking at a fairly long time frame for many of these companies with exceptional returns down that annualized return column, and many of us here have a number of those companies up at the top. It's also a tip of the hat to the Investing Roundtable, which all three of us have served on that at one time or another since 2010. And our collective performance of the stocks that we have chosen, either as knights or damsels, or the audience, checks in at 17.1, beating the market by almost 5 percentage points over time. That places us in some pretty rare company versus the field of institutional investors. We call them rhinos around here, but again, those institutional investors or rhinos are typically going to fall somewhere with those indices, all kind of laid out at the bottom of the page there. So nothing wrong with doing that, but if investing is your hobby and you like hanging out with a community like we do, it can be fun to reach for that top of the chart rather than the bottom. All right, let's go ahead and keep going. Here's an update on our ground talk. That we get that out of the way here. I was up to like 44th, and then the small caps backed off a little bit, so I'll be back. But Ken does like to point out that we are near an all-time record of groups or investment clubs that are on the chart. Those are the ones that are in bold, and pretty good representation of some long time. Look at the broad assets, and Bower City Ladies are neck and neck now at 12 and 13. They've got quite a long-term rivalry going in the Groundhog Challenge. And I guess we could cue the music from Jaws and point out that the dartboard tossing monkey has climbed all the way up to 21st. So maybe that's why.
Boy, what was he last week?
47th.
Whoa.
So maybe that explains why Ken needed a few days off, because the monkey makes Ken nervous. So good stuff. And Kim and I are both falling off the chart. I don't see Kevin's name on here either. So we'll just tip our hat to
I'm below
everybody.
the Mendoza line.
There's some.
Yeah, both of my clubs, the one I did with my 2 clubs plus me, plus my, I did something with my nephew, and all of them stink.
Now this happens from time to time. You just press on. Good
Well,
stuff.
and we didn't even have Portillo's in there, so I can't use that as an excuse.
Can't blame Portillo's, no. Our average return is checking in at right around 10%. The market's right around 10%. That value line arithmetic average continues to languish. That just means that the average medium-sized and smaller companies are still basically in the toilet. So we're going to talk about that a bit. I think, Kim, you might have inspired this one. And
yeah. I put 2 children through Harvard by trading options. Unfortunately, they weren't mine. They were my brokers.
And we don't mean to pick on options. I'd actually use options a little bit, but I just find that I can't pay enough attention to them, and they kind of I don't like the clock running out on my investments. And I just had that unfortunate experience with one of my options. I was basically betting on the Hawaii Electric situation, and again, just to learn and experience this stuff. And that was an expensive lesson. Turned out to be, anyhow. And by the way, I was right. I was just wrong about the time frame.
I think that's the other thing I'm learning about options, and actually on sometimes small caps, sometimes biopharmaceuticals that are young like that. My thesis is correct, but my time frame is really off because it seems to be some, curveballs are really thrown in there you didn't expect.
Yeah, and that's just not our style, so it's not comfortable. All right. One of the other guys that we follow that really does seem to have his head on straight is this Thomas Lee from Fundstrat, and this is actually one of the exchanges on Twitter where somebody was kind of picking on him. By the time I was able to capture it, the culprit had actually removed the post. It was kind of fun because they were kind of going at each other a little bit, and Tom basically asked him to stop whining. And Tom is basically infamous for being one of the few strategists on the street about 6 or 9 months ago that was arguing against a recession and in favor of smaller companies. We're going to look at it here in a minute, but our smaller companies have done quite well. And he basically called it. So we do kind of like to listen for him. And he does make many of the thoughts of his companies either available on CNBC or on Twitter. So it's kind of fun. It's good to run into an optimist out there every once in a while too.
Well, I think the other thing is as investors, we're biased to be with like-minded investors, but what happens is in a community like this, when people share their ideas, you get a different viewpoint of the same thing on something you may not have even thought of.
Absolutely. Yep.
That's the reason why I stay involved in both of my clubs, is for that reason. Is there's always someone who has a different take, that thinks the same way I do, long-term fundamental, and it's just like, oh, didn't think of that. It makes me a better investor.
Yeah, and I do think we talked a few weeks ago about Roger Federer talking about, he won 84% of the matches that he played during his career, but he only won 54% of the points. And I think that kind of holds true for investing. And it certainly lines up with Tillinghast's 55%. You got to be right just a little bit more than 50, and you can do quite well. So we'll actually talk about that here in a few minutes too. Here's the recent run-up that that Wall Street has noticed, and you're catching it in the nightly news now. This little run-up here on the right-hand side, it's not little. It was actually an eruption on the right-hand side over a 5-day span. That's a pretty good jump up in the small companies. It had me within striking distance of the groundhog leaderboard, and then it kind of relaxed back. But yesterday was a pretty good day, so we'll remain hopeful. And some of you will remember, we're going to take a look, but you'll remember we took a pretty deep dive on this particular exchange-traded fund looking for ideas back around Halloween, and we'll take a look at that. But it's a nice run for the Russell 2000. The other thing and this is the growth component, Russell 2000 growth, and all of the talk on the street and on the TV screen is about the Russell 2000, which is the small cap fund, which includes some of the value and non-profitable stocks out there, or not profitable yet. So I just wanted to remind everybody that it was about a year ago that we began that effort of picking our small companies for 2024. And this is just a nod to Ken Kavula and his crush on Darla and Maria. And as we have also learned, he's got a crush on the CEO of Advanced Micro. And since he's not here to defend himself, I just thought we'd celebrate that. And just wanted to point out, go ahead, Kevin, did you want to pile on or?
No, you're doing it all fine by yourself. I'll just sit back.
Just sit back and watch me sink into the.
I'm gonna. No,
Lake
I'll be
Superior.
here with Kim, right next to Kim, watching you do it all by yourself.
All right. So again, going back
With age comes wisdom.
Yeah, and we discovered that
I'm so much older than you.
Yeah, those 8 months of wisdom really probably keep you out of a lot of trouble.
8.5. Don't short me. Don't short me.
Okay. Well, again, this is just to make the point. We had pointed out that back in that time frame, starting in July and then continuing on for the rest of the year, we had pointed out during our roundtables that it was a good idea, in our opinion, to be shopping amongst the smaller companies. And those are the 4 positions from that. That is a triple leveraged fund, so it's a bit of set your hair on fire fun. And the last one there is if you want to calm down and just use a First Trust exchange traded fund. They've actually had a pretty good run also, and it's not quite as crazy as the other option. But again, Tom Lee is basically saying that he sees, probably independent of the political process, as we were just talking about a few minutes ago, that the Russell 2000 could actually take up and go up some 25 or 30% in the next few months. And we've certainly seen those type of potential moves in the past. The end of the first couple months following our selections made last October were really cool. Then it did kind of calm down a bit, but again, recently been pretty strong. So these.
I'm going to ask Mark, where you see this, that Tom Lee at Fund Straight said small caps could rally 40% by the end of the summer tanking. What is the IWM?
The IWM is the Russell 2000. That's an exchange traded fund.
Okay.
So you can invest directly in that also through Vanguard. So the problem I have with that, and this is just kind of an attitude or perception that we have around here is that anytime you invest in that, you're also buying distressed merchandise. They're small caps because they're in trouble, possibly even headed to bankruptcy or business failure. So we think that buying the growth side of that same collection of companies just might be a little bit better idea. So I would not buy IWM directly. I would not be afraid to buy this VTWG. All right, and this is something else that we pointed on. This is the Magnificent Seven, and they keep talking about how you can buy either the Magnificent Seven or small caps. That's not the case either, and I think there's room for both of them to continue northward. A lot of these companies on here have had a fantastic 12 or 15 month run, but when you take a look at the trailing 3 years or so, the numbers are really not that exceptional. They're good, but they're not off the charts good. And those companies were languishing for an extended couple of years, and they're basically back pretty close to their trend lines. And so I think it's possible for these to continue upward. I think they will. There's obviously going to be speed bumps and that sort of thing, but they will continue north, and they don't have to do it at the expense of small company investing, would be my thought. Anything on this one, guys?
No,
I just
go ahead.
Jim.
I always wonder what is going to happen to Tesla. I personally wouldn't invest in them, but he comes up with so many crazy things at work. He just, yeah.
Yeah, it's understandable. I think I did invest in Tesla for many years, and then Hugh McManus and Sean Mace basically persuaded me that they are more than a car company, and that's true. They're primarily a car company, but they're doing a lot of other stuff. In fact, last week we talked about Ann Manning installing a Generac generator down in Houston, and a couple other people's pointed out that they were doing the same thing. Well, Sean has Tesla solar panels on his roof, and they just had an outage in eastern Pennsylvania, and he went through the whole outage using his power wall provided by Tesla, without even a moment's loss of service at his house. So there's more to Tesla than that. It is erratic, and he's a very unique character. So yeah, I get it when he makes people uncomfortable. But I did buy some around $100 a couple years ago. It went up to 300, and then it proceeded to go back under 200. It's now back at 251, that you can see there. So I am a Tesla shareholder in my playful account.
Well, you can't complain if after 2 years you went from 100 to 250 or 235.
No, it's doing fine. I own everything, not Facebook, but everything else except Nvidia on that chart. So I missed Nvidia.
Me, it's Amazon is like, I just thought that when Bezos stepped down and they took the guy from Amazon Web Services, that they were going to do a lot better than this. And it's just sort of been, but I'm a little reluctant to get out of it because I got out of Microsoft in like 2012 when they were sort of flatlining, and that's when they sort of re-energized themselves to being a subscription as a software service, and Microsoft has just been kicking butt ever the last 10 years. So I'm holding out. I just think Amazon has more, but it's just sort of like not comfortable.
Well, every time I look at Netflix, I think of you, Kevin. And you were going to bring it to the roundtable, and you didn't, and it's actually done extremely well since the date you mentioned it. But you can't own a company like Netflix without expecting there's going to be those really ugly moments in periods of time. So I think your Amazon example fits that. Go ahead.
Well, the other one is that I presented NVIDIA to one of my clubs, I think in 2016 or 17. And I think I was too rigid. I know I was too rigid in some of my judgment. So I said, the PE is a little bit too high. and it just sort of languished there. And, again, not really thinking more of the mechanics of putting together an SSG rather than the mechanics of what the company does. And, that's a woulda, shoulda, coulda. It's right up there with McDonald's for me.
Yeah, and in fact, we're going to close with this topic later today, but uh, there's a lot of humility that comes with investing, and I'll put a point on this. I mean, Herb Lemkool brought NVIDIA about a year and a half ago, and we all kind of scratched our heads. And that went on to be the top performing stock at our award ceremony the following February. And that's you have to be careful about, any type of, I guess don't judge and be ready to admit that some things are right and some things are wrong. All we can do is try to do is tip the scales in our favor. So we try to do that.
And in one of my clubs, we had someone who was updating Tractor Supply, which is actually on the watch list, and we don't own it.
Uh-huh.
And they were basically thinking it was going to crater. And I think he was so focused on the latest quarters that he couldn't see beyond the next 6 to 9 months. And I think there's a lot to like about Tractor Supply in their space where they are. I'm not saying it's a buy right now because it's right up near the 52-week high, and the PEs are pretty high. But the fact of the matter is, fundamentally, I think it's a very, very good company, and it shows up both with the core score and also with the financial health grade that you get on the BI. So, again, those types of things that all of that goes back to my experience of NVIDIA and trying to be too rigid in my numbers and not thinking about what the company does.
Yeah.
Well, that's why I found that writing my thesis of why I want to invest in it and what I think the company is going to do, and then comparing your thesis on paper to what happens in the quarterly results, because ultimately we all can say this was our opinion, and then a quarter comes out and boy, we seem to have changed our minds. But if it's written down,
and sometimes you should,
yeah,
if the story changes, yeah, up or down.
exactly.
All right, so let's go ahead and move on. This is that Russell 2000 growth, that VTWG. It's an exchange traded fund. And many of you remember this. Back in last October, end of September, throughout October, we were kind of sniffing around looking for companies in this particular exchange traded fund. And here's how some of these companies have done since Halloween. It's kind of takes your breath away, doesn't it?
Yowza.
What's even more fun is we have a couple of these in our portfolios. NAPCO, thanks to Ty Hughes, and I don't remember what the other one was. And MicroStrategy is a play on cryptocurrency, but there have been a couple of them there that have shown up. And here is a look. Since Ken's not here, I can get away with showing the performance of the best small companies for this year. Again, selected last Halloween. Shockwave was acquired by Johnson & Johnson in April, so that one is a closed position. But these are the 20 companies that we selected last October. Again, we don't like to talk too much about this because Ken really does believe that the more we talk about it, the more jinx we expose ourselves to. But the collection of companies is up 52%. Here is Ty Hughes' NAPCO Securities. And we're grateful to Ty Hughes for that one. And Kevin, Western Alliance is on this list, and it's still in my portfolio.
And you don't have a rash?
Well,
I'm sorry. I should ask. You don't have a rash from holding on to too long. I'm not talking about your other ones.
Well, Matt Spielman did trim. He's had such success with Western Alliance that he did trim a little bit. So that gave me, at least a colleague in arms situation here. Ardelyx is on here still, as sluggish as it's been. It's actually done pretty well, up 44% since Halloween. So I guess we can't grumble too much about that one, Kim.
No, when you look at how, I think on October the 30th, I bought shares at like $4.10. Now Now, granted, it got as high as 9 and it's back down to, 6, but it's like, how can you complain when you made 40%?
Absolutely. So at 52%, we'll continue to be hopeful for that. I do think NAPCO will probably get one of that upgrades in this forecast the next time that we take a look at their quarterly report. So, because they've been going pretty good. But again, many of these companies were discovered sifting through that exchange traded fund and other top performing mutual funds. Just wanted to put this one out there. I've been tinkering around with a microcap club and corresponding with Ian on Twitter a little bit. A couple of his recent articles are here. You can actually go in for free. This is a membership club with a paid fee to join it, but he does put out a blog with some excellent educational content. If you want to take a look at either of these two articles, they're down at the bottom there. I think we will spend much of an entire session on the super investors of microcap. That includes people like David Gardner and Morgan Housel we'll talk about here in a minute. And just to make you aware that you can do this, you can do it for free and experience their blog. And then Kim also finds that she gets some ideas for spin-offs and that sort of thing. So you want to give us a little summary of, why this gentleman captures your attention, Kim?
This guy writes he writes a newsletter called The Edge, and they give reference material to the bigwigs like Morningstar and S&P and all that. And one of the things that I read in the article that really hit me is I had looked at all the spin-off ETFs, and I was reading an article about it that I had found, and he listed what things he specifically likes to look for. And let me read one of the paragraphs here was, we like to look at the insider's interests. Too many investors look at the sales. They mean very little. Insiders sell for a variety of reasons, but they buy for only one reason. You look at open market purchases and consider the history of the insider. Have they been any good in the past buying their own shares? Are they a value or a catalyst buyer historically? And what are their incentives going forward? Is the management credible? How do they benefit from a rising share price? The best spin-offs have high insider interest backed up by open market purchases. And that is a prime example of when you have an insider who puts their own money into it, find out if they bought it with their own money and they had to open their wallet, or were these just shares that they got because it was part of their reserve stock plan or their executive compensation. I don't really look at what they get in shares for executive compensation. I look at when they're spending it on their own money, they had to open up their own wallet.
Yeah.
And
go ahead.
And when I presented a lot of that paragraph talked about how I, on the round table, bought LILA at the end of March. I presented it at $6.89 was Liberty Latin America. And what really interests me is I had found that there were 3 insiders. Between the 3 insiders, I think it was within a 2-week period, 3 insiders had spent over $1 million to $2 million on buying shares. But then in the total month, I think there was 8 insider purchases that added up to like $5 million. And I'm like, that to me is like a green flag. What's going on here that these people are opening up their pocketbooks, spending their own money? Because I have a pretty high threshold that if they're going to buy stuff with their own money, I like to really be greedy and saying, are they spending $500,000 to $1 million of buying their own shares?
Yeah, and I think in that context, if you can find a situation like that, we did notice when David Mott bought shares of Ardelyx a few years ago. So it can be quite a factor. By the same token, we all know that mergers can be quite challenging and they very rarely work out as well as they originally are expected to. And I think the spinoffs are the same way. When you find a good spinoff, though, as like we've witnessed with General Electric, it can be most rewarding. So it can be an area of potential opportunity. It's a tough minefield out there, though, from my perspective. And just to
It
encourage
is, but
everybody.
there's some guidelines you can always say, like, follow. If you have insiders who are they staying with the parent company or are they going to the child company? Where are the insider executives going? And where's the debt going? Because a lot of times the management will dump the debt off of the parent company onto the child company because ultimately they're trying to clean up their balance sheet. But if they actually make it so that they're giving the spinoff some extra cash so that they can get started and then they can pay off the debt easier, those are the things. And then your Mark's going to show us some slides here further on of different books that we could read. And there's that one book that I read that talked about spinoffs, and it really talks about all that in there very, very distinctly and tell you what factors you should look for. And it's been very profitable because I have some spinoffs, that I got at $39 and they're $400. So yeah.
All right, so we'll probably come back to that subject. Well, let's talk about the books for a minute.
Mark, before we get too far along,
Yeah.
Can we back up? Nick had a question. I didn't get it fast enough. Go
Okay.
back to the small cap stocks, the small stocks that you had from a year ago.
Which
the top performer, or just your list of one? I think one more before that. Were the ones that you and Ken, you were showing the relative return and the prove, and Nick was asking, is approved numbers within the 5-point parameters when those stocks were selected last October? When is that? I'm trying to see. Yeah, what's the time frame on that prove, or is it just what it is right now?
That's current now. So yeah, at the time of selection, that would have been somewhere in that 10% range on all the companies here, 10 to 20,
Okay.
Something like that.
That's it.
Okay. Thanks, Nick. All right, we'll press on and talk about some of our favorite books on investing. I got to tell you guys, I had to go back and dig to find this. So it's been a couple years ago since we did this, and I was running into all kinds of stuff. And Kevin knows how easily distracted I am. I just kept getting lost in some really interesting topics, and more on that to follow. But this was the collection of books that people basically nominated and presented over a period of several months. And the reason I had done that is because this had come out. I can't remember exactly who put it out, but it came out. It's a little bit, I know the titles are a little bit small, but these are the top 100 popular investing books as kicked out by these Goodreads ratings, where people rate books after they have consumed them. And I don't think that the color scheme is all that meaningful. These are the top 100, so they range from whatever that, it's probably a 0 to 5 scale, 4.5 down to 3.7. But it's just kind of an interesting shopping list. I've read many of these books, not to brag, but I just find it very interesting that a number of these companies do show up on our favorites list, and just kind of a place to go looking for books maybe to explore. Number one ended up being this one. I'd heard of it. I have not read it. How about any of you guys? Are you familiar with it, or have you read it?
I have read it in my book club.
Okay, what was and this is a very distinguished book club. What was the consensus, Kim?
We really enjoyed it. It taught, I mean, it lets you know your individual biases and what other biases are out there, and how wealth does not necessarily make you happy. It makes life easier, and how can you be happy with just what you have rather than always chasing the golden ring?
Yeah, and I mean, they talked to some people that are definitely very high on our favorites list down there in that next to last paragraph. So
right. Charlie
I'm
Munger, John Templeton, Jack Bogle, Ed Thorpe, Monish Purvai, Joel Greenblatt, Howard Marks. Yeah.
those guys are all on my short list of people I pay attention to.
Well, yeah, because the other thing is it's not just that they make money. Many of these also have great philanthropic events on how they specifically try to grow their portfolio so that they can give to others.
Interesting. Good stuff. So I will take a look at that one. Again, that's number one on the list is Richer, Wiser, Happier. And then I also couldn't help but notice that Morgan Housel is down there at 4.3. But the thing that's really noticeable is the number of actual reviews or ratings is given also. And he's at 170,000 compared to the guy in the number one slide at 5,000. You can see that Morgan Housel actually has one of the top, at least in terms of activity. So that is a company or a book that we featured and talked about several times last year. So that one's going to go into our recommended list. And I've also circled the other ones that are in our library of interest, if you want to think of it that way, including the Peter Lynch classics and Greenblatt and Bill Fisher. One of my favorite books on Buffett is The Snowball. And
Well, there's also Morgan. Charlie Munger has, upon his death, he had written another book, and it came out, and it's more. We read that book, and it was very good. I'll have to get you the title of it, Mark.
get the title because I do think I want to take a look at that one. And I know they were handing that out and selling it in Omaha a couple months ago.
Yeah.
And again, it's just an interesting thing to go through and take a look at. I would probably set aside some of the real estate and trading books, but do want to take a look and see if there's anything here that can be explored because we had a real nice time with both of these last year. Talking about Morgan, he's a heck of a writer. He was the featured guest at Fool Fest last week, so I got to see and hear some of updates on him. He's coming out with another book, and then of course Joel Tillinghast's book that Matt Spielman did so much with last summer. Just a fantastic book that rhymes with everything we think about. Tillinghast is the very long-term manager of the Fidelity low-priced stock fund. So he was a colleague of Peter Lynch, and many of the things which he covered in that book just dovetailed very nicely with Matt's Annie Duke presentation that he had done. Any thoughts on the list, Kevin? I know you.
No, some of the ones I'm reading are not on that list. One I'm going through right now, I'm looking at it, it's an old classic that's been reissued, 100 to 1 in the Stock Market by Thomas W. Phelps. I found it actually over in Thrift Books, but he wrote this after 45 years in the stock market in the early 70s. So even before really the modern stock market, with where you had to go through brokers and there wasn't an internet and all that kind of stuff. And some of his messages, I think, are still appropriate today, and really sort of struck me as we sometimes get so focused on all the bells and whistles that we sort of forget to think, like an owner of a stock. A company rather than a stock operator.
What's the last name again? I'll look it up and put it in the show notes.
Thomas W. Phelps, Phelps.
Okay.
My ultimate line out of this is that it says here, he goes, he was talking with, he at one time was an editor of Barron's back in the 1930s, was a fund manager, worked on the fundamental side, worked on the technical side. And here's a line that struck me the most out of this. Never forget that people whose self-interest is diametrically opposed to your own are trying to persuade you to act every day. Who is talking often means more than what is said. Try to identify people whose interests correspond with yours. I mean, all this news and research that we can get either from our brokerage or from like Yahoo Finance or Google Finance, all of that is designed to get you to act on something that they want you to do rather than what you should be doing.
Interesting. That kind of rhymes with the Social Network movie a little bit.
And he wrote that in 71 or 72.
Wow.
Doesn't it sound as fresh as if it was written just last week?
Absolutely.
Well, there's another book. Well, the book we're in the middle of right now it's called Influence. It's the new and updated version on the psychology of persuasion, and it's written by I know that Buffett has been promoted this book before by Robert Cialdini, a PhD psychologist.
Okay.
And it's exactly kind of what Kevin was talking about. How are we inadvertently not even recognized on how we're clicking on something and we're buying the bait? And we have biases, and they talk about it in the book. Like, number one, how many of us go to Amazon and we buy the most recommended of what we need, and even though it may not be the best one for us individually?
Good point. Good stuff. All right, so we will continue to go over that list. One of the things I think we're going to end up doing, one of the things I found interesting, just thinking about that list, the favorites from the Goodreads people and ours, is there's some pretty interesting books that are not on their list that we found interesting. It's just as one tangential example, and it kind of rhymes with what Kevin and Kim were just talking about. This Factfulness book, many of you out there read it, and we have talked about it quite a bit. It just defying some of the conventional wisdom stuff that's out there that's not incredibly factual, and just challenging biases and all that sort of thing and thinking. And then I know Kim, this is one that's not on that list that I would say is has to rank pretty high in your library.
Oh, absolutely.
Jake Taylor.
Yeah. And then there's that You Can Be a Stock Market Genius, and that's my Bible about spinoffs.
Yeah, exactly. I was thinking that when you were talking. So there's some other ones there. That Investing for a Successful Future. That was the first book featured in Better Investing Magazine's book review column back in 1960 by David L. Babson. And so that one's good. Fisher's book is good. It's one of Hugh McManus's favorites. Of course, the Investor's Manual that many of us know, The Motley Fools. This is the book by the guy who invented and started Value Line, Arnold Bernard, The Evaluation of Common Stocks. If you are having struggles with insomnia, great one to put on the nightstand. It's a great book, but boy, it's something else.
A little deep.
Yeah, here's that book by Jim Clunan. And again, we did a number of sessions on it, and even though he speaks a slightly different language, he definitely thinks very much like George Nicholson did, and kind of interesting to compare the two. And of course, the Peter Lynch series here. So what I'm thinking, and I'll mention it to Ken, I think we almost need a bookstore with different sections, classics, nuts and bolts, that sort of stuff. And maybe we redo this a little bit, and we'll have some fun with that. And here's, of course, the two that we would have added based on last year's work and experience. So good fun. So anybody, if you find a book that's really enjoyable that stimulates the discovery of the right kind of ideas that we like to do, let us know. We'll take a closer look. All right, we'll close today with a little bit of discussion about the electrification portfolio that again, going back through the stuff, I kept getting sidetracked, like our session on pointing out that the first automobile was an EV back in 1881, and just a lot of fun with the electric portfolio. Again, just pointing out the quote from, again, talking about books that are not investing books that definitely affected us greatly. George Gilder's book, Life After Google. Highly recommended. I will be rereading that again, probably lakeside here in a couple of weeks. But the message here is just these notes about how much power and energy is going to be required for what lies ahead. And that rhymes with a nudge from a couple of you, including Laura Scott and the Florida bunch, about how the reality of we're going to have a fairly big jump in the amount of electricity consumed by these data centers. And goes through and gives the fact. This is actually a screen capture from a few months ago at Scientific American, so you can go ahead and learn what that's about. My takeaway from that is kind of along the lines of why we did the electric portfolio that we did last summer. We'll take a look in a minute, because this is inevitable. There's the people who supply stuff and services to the generation of electricity probably deserve some attention to be considered as potential investments. Any thoughts, guys?
No,
Nope.
I just want to make sure, even though we may have to have these data centers, if it's a choice between data centers and air conditioning, I'm choosing air conditioning for me.
Well, it could be a tug of war out there. All right, here's the company.
Tim, maybe what you ought to just do is you ought to live inside a data center.
Not a bad thought. They've got backup systems. Anyhow, some
And
good
they're going to be cool, so you'll be fine.
So anyhow, the people who make the wires and stuff that are involved here were among the companies that we chose a little over a year ago. Doing pretty well, not knocking the cover off of it yet, but by show of hands, who when we picked these companies, who thought General Electric was going to end up at the top? And I don't think there are any hands up.
Not me.
No, I
And
mean,
especially because it was going to be a spinoff, I didn't think it'd be any good.
and that spinoff did very well. And of course, Siemens, Honeywell, ABB, they're all in that. They build the wires and the machines and the stuff. And there are some other service companies here, but they're all doing pretty well. Couple down at the bottom kind of got blindsided by a couple different forces. Shoals Technologies is obviously a solar related company, so not so sure what the future holds. There's our Tesla. And we talked a little bit earlier about First Trust. If you follow First Trust, they've got a pretty good track record of picking companies by theme, and this is that GRID. That's an exchange traded fund that you can buy and actually own all of these at once, because most of these companies are in that First Trust fund. And we just put it there because we found it to be an interesting source of ideas. And last but not least, we talked about graphene. There have been some advances in the graphene technology over the last year, and we put Cabot in here just to hold the place because there's no, at least not of any substance yet, company that specifically makes graphene in a commercial or industrial production mode yet. And we just want to stay on top of that and try to be out in front of that investment as it could materialize. That one just changes the whole. It's a game changer, huge game changer if graphene actually comes to fruition. All right, so those are the companies that we picked. Let's go ahead and close up today with a quick look at the Buttonwood portfolio. Kevin, we got Western Alliance in here too, so it's just a Beetlejuice moment again. Up at the top, doing pretty well. I'll actually put together a performance number on it now that's got a few months in, and pretty happy with the performance of it. A couple of those down at the bottom have taken a bit of a hit. You can see that the top performing stock, at least by percent of total assets or dollars, is Green Brick Partners, which we can blame pretty much blame Matt Spielman for.
Well, I think he'll take all the blame and the money.
Yeah, I think he's actually had to lighten up on his personal position in that one also. So some good clean fun there. And we probably will, unless something dramatically changes, be talking about when we add a little bit of money to the portfolio, challenging that one to see if it should stay in the portfolio as one of the lowest projected annual returns. And it's got a very mature growth rate also. So it's just the type of company that bothers Ken enough that we might be talking about swapping that out and replacing it with something else. And
I would go here.
yeah, and Diageo is a tribute to Kim and her presentations at the roundtable. And
I'll drink to that.
And you'll drink to that too, huh?
No, just to Diageo. I'm not going to drink to Thermo.
Okay. All right.
Well, I mentioned Lulu Athletica and the BI Gals Talk Stocks too.
Yeah, that one's hit a speed bump, considerable speed bump, but again, I think that probably falls into that same category as Netflix and some of the other companies that Kevin was talking about. It's a high flyer that's going to have some tribulations from time to time. The difference being, boy, if that ever goes out of fad, or if they get some formidable competitor, the landscape can change pretty dramatically, and that's what frightens many of us about a company like
Stop.
Lulu.
My word to you, I have one word.
One word,
It's not plastics.
and it's not plastics.
Stop loss. Stop loss.
Stop loss. Good stuff. All right, so I wanted to close today with a question from an attendee. And Julie, if you want to go live, just raise your hand. A little bit of a debate in a recent investment club meeting. It was kind of uncomfortable because there was a difference of opinions, and that's a good thing. Anytime we're making assumptions and trying to pick solid investments for the future, you are going to run into situations where opinions will differ. I mean, we try to operate on the same playing field. When we look at Green Brick Partners, a couple of things that you do need to keep in mind, and this is something that Matt has talked about extensively. First of all, if you're not familiar with the company, some have referred to it as the Berkshire Hathaway of real estate. The reason that they do that is the principal owner, and I do not know his name, but the founder of the company basically goes around and finds very respected home builders in areas that have great potential for growth. So Dallas, some of the areas down in the Dallas region. They also have operations in Atlanta and the Sun Coast of Florida, and they had in Denver. I think they are swapping that out. They probably will be restored to the Denver and Aspen area, but they find people who are very respected and really have solid execution and delivery, and they kind of leave them alone, much like Berkshire Hathaway does with their individual holdings, their individual companies. So they've got a really strong track record. It is championed by David Einhorn in his hedge fund. So that's where the name kind of comes from. And one of the things you have to be careful with when you look at this company is if you go back too far in history, it's not the same company. The company actually did an evolution or a transformation in the late teens, and so you can basically disregard any operating history that goes back very far. So you want to focus in on recent history and the expectations going forward. And again, the underlying premise here, or thesis, as Kim would put it, is that we do have a massive shortage in real estate nationwide, especially for some of these younger people that are beginning to buy their first homes. So there is a fairly solid field of demand. And if they execute well and present the opportunity, these guys have a bright future. So again, we're
Mark,
talking. Go ahead.
have you or Kevin read that 60% of the single family homes out there are owned by 3 different hedge funds?
No, I haven't heard that.
I'm familiar with that observation. I think it's been, I hate the word debunked, but debunked.
Well, I hope it has, because that's just the way that all that is if you have a single family home and it's a rental unit, then that's a reoccurring revenue for them, and then someone may never be able to get their own home. I kind of believe in the American way of trying to have that.
Yeah, and that came out, I want to say about a year ago, maybe a little bit more than that. In fact, there was an excellent presentation put on by Graham Stephan. And I will add that. I'll add a link to that in our forum, where he was invited to speak on Fox, a television program. I think it might have even been Tucker Carlson back then. And they wanted him to basically reinforce what you're talking about. and he
Right.
didn't reinforce it. He basically said it's not true. Well, mysteriously they lost the connection and cut him off for a commercial, and they never brought him back. So he does kind of a hilarious takeoff on that. Um, yeah, there obviously are investors in this area. I don't think it's anywhere near the extent that was suggested by that um, factoid or whatever, but it's out there. So again, what you're looking at here is a company that is operating in a field of opportunity that would appear to be promising, and the demand is out there. Obviously, if the economy were to have tremendous challenges, they would also have challenges, but that's always been true. But the thesis again is that we probably have not built enough houses for nearly 20 years, and so that's out there. So you're looking at a company that's $2 billion ish in sales, growing at 10 or 11 or 12% per year, as you can see on the right-hand side of that. So as you do your study, that's where your numbers should probably land. A projected net margin in the mid-teens, and their profitability has been fairly steady. A PE ratio in that 13-ish range seems to make a lot of sense. Using those numbers, you're looking at a return somewhere in the 13 or 14% range. For most of us, especially with the market trading around 9% or 10%, that's a potential buy. At the same time, you could put together an argument that is much more bearish or less optimistic about what the future might hold for the next couple of years. So it's possible to
Mark,
be.
speaking of bearish, Len Douglas just sort of said he pointed in the chat box here. He goes, didn't Zillow get creamed when they were buying all the houses that they could? I haven't really been following that area.
He's reading my mind. I forgot to mention that. Thank you, Len. Yeah, in fact, that dovetails with what Kim was talking about. Zillow did try to get in there head first and just got massacred. Real estate's local, something that Matt talks about quite a bit. Again, that emphasis on Dallas and Florida and Atlanta. That's no accident because real estate is local. And as I have discovered moving from California to Illinois to Michigan, they're not the same. And
Well, I think the other thing is that you have, where is the greatest amount of population coming to because there are jobs, and where are the best jobs in the socioeconomic area where people can afford houses, and they want to have, this generation wants to have they want the sidewalks, they want the park area for the kids, and they're building that kind of a subdivision for those individuals.
yeah, there's another company out there called American Homes or something like that, which is basically the same type of playbook, but they're centered more in the Carolinas and maybe a little bit into the Virginia area. But they're basically doing a very similar thing, and it's based on what you're just talking about. Not only places to work, but places to retire to. And anyhow, we look at this company and we see a fairly attractive picture, a decent return forecast, an improving quality situation, and again, disregarding the distant past and paying more attention to the right-hand side. It's a pretty good-looking picture, both from the actual results and the expectations, which, by the way, are down a little bit. They're subdued here on the right-hand side. Here's a look at their profitability over time, which seems to be improving and perhaps stabilizing in that 20% area. But you can find reasons to be slightly concerned. One of them is that it has had a heck of a price run up. We'll take a look at that in here in a second, running up to a relative strength index of 79. That just simply means that it's been on fire. That's why it's the number one position in our portfolio. But Morningstar thinks it's fully valued. The analyst consensus, which is generally pretty optimistic, is also pretty close to fairly valued. And apparently the analysts on the street, there's only 4 that cover this company, need to do their homework and probably change that number because it's trading above their 52-week target price right now. Here's a look at that long-term price graphic that shows that they've been on quite a run. up into the 70s, and they are up at 69, and actually have ticked up here a little bit here lately. So on the right-hand side, they are trading at levels which they have done before. But somebody could make the argument that, especially if you were in a situation where the club needed to fund a withdrawal or whatever, when they have reached these levels in the past, here's one here where they hit either a flat spot or a decline. Another one here where the relative strength index got overheated, overbought, and you could make a case that it traded in a range for up to a year after that. So again, you're looking very long term, you can see it one way. If you were looking at it with a slightly different time horizon, you could have a completely different perspective. And just something to think about. So Julie, I don't know if that gave you some ammunition or fodder to think about, but that's kind of the way we would see the company at this point. And it's certainly within the context of the Buttonwood portfolio. Nothing wrong with the par, nothing wrong with the quality, and a decent growth rate. And again, we're looking at a portfolio which is being fairly assertive at a 17% growth rate, excellent quality, up in the 85 to 90 range. We would like to see a little bit more return forecast, and that'll probably naturally take place either with prices dropping on our current holdings or with the additions that we make going forward. So we're a few points ahead of it. We'd like to be a little bit higher on the overall portfolio return forecast. All right. Any other comments, guys? And again, I think a PE ratio for this type of company, I think Value Line is overly conservative. With this, it's something that Matt and I have debated. I think that it's very, very feasible for a company to be in that 12 to 15 PE ratio range based on that environment, which is got quite a bit of opportunity in the years ahead.
Nope, nothing more for me.
All right. Well, let's go ahead and close down then. Here's our reminder that we do post these sessions on YouTube under the Manifest Investing channel. That includes the bull sessions and the roundtables. We are a week away from the July roundtable, so we will begin shopping for that, and we'll probably have an abbreviated session with a little bit of roundtable shopping a week from today. We are going to dive deeper into buybacks soon, especially as I was looking over the field of companies and noticing the declining number of outstanding shares with so many of these companies. And then we will leave with some pictures from what starts later this week.
Yeah.
And that's actually people swimming in the Seine.
And before they were diving into the Seine, we had people diving into the Inner Harbor here in Baltimore. I don't think I'd jump into either one of them.
Yeah, I don't know. Have we ever had people swim in the Hudson or near New York or not, other than Kramer?
Don't know. Well, the problem is that both the Seine and the Inner Harbor, they basically became they were open sewers because that's where the stormwater runoff were going into that.
Mm-hmm. I guess
we're trying to fix ours up, and we also were a port, so between that and all the industrial sludge that goes in there, it's needless to say, it's not a very healthy body of water.
Yeah, and all that bridge debris too that's there now.
Well, they've gotten rid of the bridge debris. Most of the problems are north of that in the Inner Harbor, which we have. Again, some people have jumped into the water to do it. They've been tracking it, but it's sort of like I saw a thing on, I think it was like, Modern Marvels that were showing what they had to do to be able to improve the water quality out of the Seine and how long it went back. And I was just like, wow.
Yeah, it's a dramatic change from what it was even 20 years ago, based on the stuff I was reading.
Is it even? I don't know if I'd jump into it. I think I'd still wait. I'm a skeptic.
Well, they had some high-ranking government officials swimming around in it fairly recently, so we know we can trust them.
The mayor did, yes, but that they lose IQ.
That doesn't tell us about their brain quality.
Correct.
Or maybe it does.
I'm with the lady from Indiana on this one.
I'm going to leave it alone because I'm in enough trouble already. All right. Anything else on the hopper? Any other questions or comments?
Julie seemed to indicate that what you talked about with green brick was helpful somewhat, but not. It sounded like she didn't quite get it all.
Well,
So.
I'll speak on her behalf. She was talking about a meeting which became quite an active debate, perhaps even a little bit contentious between a good friend, experienced investor who had a differing opinion, and that happens. I mean, I can remember making up his, again, one of those best investment studies, presentations in the history of man to my club back, this is 20 years ago now, maybe more than that, on Clayton Homes. And my club was having no part of it. I mean, I was throwing furniture and food and all kinds of stuff, throwing a temper tantrum. I couldn't budge them. So, I mean, it does happen. I'm exaggerating, but it does happen. And you have to be willing to recognize that uh, there can be situations where both parties are right too. It's a tough one. It's a tough one. All you can do is just kind of try to take a step back, take a deep breath, look at the facts, and challenge some of the assumptions. Um, I would, as Kevin was talking about earlier, and feel free to jump in, Kevin. The numbers on this page are basically the analyst consensus suggestions from a fairly small group of analysts, like 4 analysts. And what I would do in a debate in an investment club setting would be, okay, what do you think the sales growth potential is? What's the forecast? If the individual is using 4 and you're using 10, which agrees more with the analysts, you can debate, who's right. What about the profitability? Does the person who is presenting say, well, these guys are naturally headed back to this, and here's why? That could be a compelling argument for, reducing the profitability forecast, which can change the outlook. Same thing with the PE. What do you think about the PEs? And again, if the person making the bearish argument is saying I'm using a PE of 4 and you can't change my mind, I would look at this and say, wow, over the last 10 years, it's at least averaged 8. And so I think taking those 3 milestones and doing a comparison and having that type of a debate, a polite debate, might be helpful.
No, the other thing is that we've had arguments. I don't want to say arguments. We've never had really knockdown dragouts in either of my clubs over the 20 years. But when people disagree, sometimes I've gone out and bought it and done really well, and other times other people have done that when we as a club didn't want to purchase it, but they bought it. And that's your option, is that your club may disagree with you, and that's fine. But if you fundamentally believe in it, go ahead and purchase it.
Yeah, I've done that a few times too over a career with investment clubs, and again, the results are probably mixed. A lot of times, the people that failed to convince me were right, and maybe I had a blind spot or a bias about something that got in the way, or simply the company failed to execute on my vision for them, which can happen.
Well, I think the big thing is if we recognize and accept everyone is entitled to their own opinion, and if your club chooses not to invest, you always have the choice to invest in it yourself.
Absolutely.
Hear, hear.
And try to keep it as polite and diplomatic as possible. Ken tells a story about the 2 ladies walking out when they sold Chico's in his investment club. So these things happen. Just press on and be diligent and find good companies at a good price. So with that, I think we'll go ahead and wrap up. Thanks, guys, for chipping into the discussion. And everybody get out there, find some good stuff. I do have some tickers and things that have come across my email that I will be adding to coverage at Manifest. And Kevin, I'll send you the stuff we had discussed previously.
Very, very good.
All right.
Thank
Take
you.
care, everybody.
Thanks for having me. Bye-bye, guys.
Good afternoon.